Okay guys, looking forward now, moving on from the next episode where we highlighted about the cash flow strategy. We're now looking at how real assets relate to the cash flow strategy. Now, a real asset is something that you can physically see, you can touch, it exists. Obviously, the real asset that we're referring to today is commercial property. I'm not relating it to residential property in any way, shape or form for this particular episode. The difference between commercial and residential, there is quite a difference. A couple of key notes are that the tenant pays all outgoings, land tax, council rates, water rates, repairs. It also provides a more consistent income cash flow. It's also underpinned by obviously defensive covenants that we talked about as well. So this is purely in relation to commercial assets today and the real returns that they provide. What we want to demonstrate obviously is that if you're investing in a real asset, it's obviously very hard to sell down that asset very quickly. Unlike the stock market where a lot of you have experienced some serious hardship today. You know, the stock market dropped, over 20-30%, in a couple of weeks. In the United States, even further than that. It's because it's such a liquid market. In an illiquid market like a real asset, where it's harder to just sell down, someone who's buying these assets needs to review them, they need to contract them, they need to do their due diligence, they need to understand the covenant, they need to go through all an array of, planning investigations, building investigations. It's what holds the market more stable. The illiquidity is what is actually making the asset so much more attractive and so much more safe. With consistent cash flow returns, commercial assets, the rent and outgoings are paid monthly, so you're receiving a monthly distribution. It's a whole different context as well to add in that you can claim back depreciation, you can write off your interest repayments. You can speak to your accountant about all the benefits about investing commercially into commercial assets and the returns that you can leverage. And when I say leverage, because you can boost your return on equity through leverage, you can play within a safer field. I use the word safer. 50%, 55% LVRs with a minimum 2-3 times interest cover make the asset really secure and still allow you to prop up your return on equity. The diversified income is having, the opportunity to buy multiple assets or invest in a trust, an unlisted property trust, like a syndicator who might have multiple properties in multiple states with multiple defensive tenants. I'm not saying that there's not syndicators out there with exposures and exposures to markets and tenants that are impacted today, but if you're looking today, you can invest in those funds or in new funds that are coming out that only invest in defensive tenants. It's the reliability and the distribution of the cash flow that you really want, so that if you were to lose your earned income, lose your job, you still have a distribution every month coming through the door. And it's safe, it's secure, and it's a great return. I'm not even taking into consideration the equity growth that you're getting every year. Typically, the rent goes up every year through an annual increase that's inbuilt into the lease, or through a turnover rent mechanism that, say, a Woolworths or a Coles is paying. These benefits will give you more certain, secure equity growth in your property. So not only have you taken a cash flow distribution every month, but when the property is sold and the profit is realised at a higher sale price, well then you're also getting your initial investment back, plus your capital growth or equity growth, plus the cash flow return that you received every year. Coming into the short, medium and long-term strategy, typically these syndicates or these investments, if you have enough money yourself to buy an asset of this nature, whether it's a service station that's a circa $5 million bracket price, or maybe a supermarket or a logistics centre at 10 plus million, you're going to be locked in, or you're going to be in a position where you're holding this for a minimum of 3, but more likely 5 to 10 plus years, taking those distributions, that positive, consistent cash flow, and potentially wanting to realise your equity uplift when you go to sell. They are more a defensive strategy, and re-looking at your exposures in the future might be something you want to do or something you want to do today, and we'll be here to help you look at how you can get in contact with these syndicators if you're someone who can't buy the asset yourself, Or if you're someone who wants to buy these assets outright and you have that cash right now or that equity to buy them, we're more than happy to speak to you about that.